Social Security is one of the most complex and confusing federal programs. With over 2,700 rules, it's no wonder that we're confused about when and how to start collecting and who to turn to for help. Welcome to Social Security Answers from the Experts, hosted by Martha Shedden. In this podcast series, Martha meets with professionals to provide you with the answers to questions about this most important financial decision. And now, here's your host, President and co-founder of the National Association of Registered Social Security Analysts, Martha Shedden.
Hey, hello everyone. Welcome to the show. I am your host, Martha Shedden, and today I have the pleasure of welcoming Robert Powell to the podcast. Bob is a CFP and longtime award-winning financial journalist whose work appears regularly in TheStreet.com, USA Today, The Wall Street Journal, MarketWatch, and AARP. He is the editor and publisher of TheStreet's Retirement Daily, and over the years has served as an editor-in-chief, podcast host, co-founder, curriculum director, author, speaker, and content strategist. Bob, I'm so happy to be talking with you today.
Martha, I'm happy to chat with you too, and thanks for the lovely introduction.
You have watched the Social Security and retirement landscape for a long time. What developments are currently happening that you would like people to be most aware of?
Yeah. So I think the thing, the elephant in the room is the possibility of the trust fund, becoming, I don't want to say bankrupt, but the trust fund becoming exhausted, and the possibility of less income coming in than expense than payment benefits going out.
Right.
And everyone says, "Oh, Congress will do something. They'll wait to the last minute, but something will be done." On the other hand, if nothing's done, the possibility exists that people will get 80 cents on the dollar of their benefit, give or take a few cents here or there.
Yeah.
And I really think that people should do two things. One is take seriously that possibility and start planning accordingly, right? And to say, well, best case, it's still 100 cents on the dollar of my benefit. Worst case, it's 80 cents on the dollar. And how does that affect my financial plan?
Mm-hmm.
Now, we can all go through lots of machinations to say, oh, if they do anything, if they do reduce benefits, it won't maybe affect the people who are presently retired or about to retire. They'll do what they did last time in terms of raising the full retirement age. They'll do it gradually over years to come. And so maybe the people who will be most affected by this, if nothing is done, will be my sons and daughters who are in their 20s instead of me and perhaps you, right? As we think about what our benefits would be. But what would happen if it was across the board and this 80%, this 80 cents on the dollar haircut affected everyone? So I just think that we all need to plan for the however remote possibility of a benefit cut.
That's the really good conservative way to approach retirement, because then you're not going to be surprised if it does happen.
Right. Right. And I also think, Martha, I mean, the other thing when we think about Social Security, sometimes we talk about averages. But what I also think is important to think about Social Security is how important it is to lower income Americans versus, say, higher income Americans, where for lower income, Social Security represents maybe 90% of their retirement income.
Big part, yes.
Right. And for higher income, maybe it's 10 or 15 or 20%, and much less, it's a much less problematic if we have a benefit cut for higher income folks.
Right.
And I think we have to think about, well, does the benefit cut really harm the people who need it most?
That's right. That's right. You wrote in a MarketWatch article in March that saving for retirement is easy enough, spending it is more complicated. And you quoted Nobel laureate William Sharp. And I've shamelessly stolen this from you because he quotes, decumulation, or the use of savings in retirement, is the nastiest, hardest problem in finance. And man, that's true. Can you describe to our listeners why that's so different than the accumulation phase and what's involved in that?
Yeah. So, I mean, accumulation is easy, right? You say, I need to accumulate $1 million by the time I retire at 65, and I need to save this much and earn this much on my money. And along the way, I can make some adjustments. Maybe I start saving more, or maybe I delay my retirement. But once you get to retirement, you've got to figure out, okay, what's my planning horizon? How long will I live? Is it 10 years? Is it 30 years? Is it 35 years? And it matters how many years you'll live in retirement, because your money has to last that long in order for you to fund your desired standard of living, right? And so what's interesting about that problem is, I joke, I tell people, if you could tell me your date of death, I could build you I could build you a bulletproof retirement plan. But since we don't know your date of death, we've got to factor in all these possibilities, right? We've got to factor in what you're spending, what the rate of inflation will be on your expenses, how your expenses will change as you go through retirement, through your, right, the go-go years, the slow-go years, and the no-go years. And what we know is, and what the financial planning community will tell people is, oh, you should expect to retire on 80% of your pre-retirement income. And that on an inflation adjusted basis, right? Then, by the time you get from age 65 to 95, maybe the $100,000 that you retired on at age 65, well, now you'll need maybe, I don't know, 130,000 in order to support your desired standard of living when you're 95 years old. But the truth of the matter is, it's not a straight line for retirees. What they tend to do is to decrease their spending as they go through retirement, even on an inflation adjusted basis. So what's happening, I think, in terms of like how hard it is people don't know how much they can actually spend, right? Because they don't know how long their money has to last. So what happens is, and what many of the academics will say is, well, what we know is true is that people are underspending in their early years because they fear that they may need that money in their later years to fund healthcare expenses.
And that's so true. Just as you're saying that, and it's so sad, because then that is the go-go years. That is when we should be able to go out and enjoy it. And to have that security that your healthcare costs and long-term care is covered, that's the hardest thing.
Yeah. So I would add to that, right? I mean, one of the things that when I think about retirement, different from the accumulation, saving for retirement, is this notion of all the risks that you'll face in retirement and how important it is to understand, right? The Society of Actuaries has, I think, 15 risks that you'll face in retirement. And it ranges from longevity to inflation, to healthcare shocks, to divorce, to death of a spouse, to market volatility, et cetera, et cetera, et cetera. And if you were to go about this prudently, you would say, I do face this risk. I have exposure to this risk. The probability of it happening is high, and the consequences would be negative if it happened to me. And this is how I plan to manage or mitigate that expense. And for me, that takes a lot of the worry out of retirement planning, which is to say, if I'm worried about healthcare expenses, but I haven't taken the time to manage or mitigate the risk of those expenses, well, yeah, of course you're going to be worried and not spend when you should be spending. But if you say, oh, I bought a long-term care insurance policy, so, right, that gives me the freedom to now spend my money early in retirement, like you said. And well, it's interesting, the RAND Corporation just did some research, and they were explaining the reasons why people stop spending as they go through retirement. One of them, obviously, is the fact that you're just, you're scaling back on your whatever, your travel and whatnot. And part of it is they describe it as utility, the satisfaction you get from spending money. And one of the reasons people stop spending money later in life is that they say, well, I've already done that. I've already taken an around the world cruise, or I've already visited the Grand Canyon. I don't need to do it again. So the money that they spent early in retirement, it just starts declining. And it's just yet one more reason why people should spend more in the early part of the years, presuming that they've managed the retirement risk that they worry about, right? So the two big ones being, well, three big ones, but fear of outliving your money, right? Longevity.
Yeah.
Yeah. Inflation, we need to make sure that our money is at least keeping pace with the, you don't want to lose purchasing power.
Right.
And I think that healthcare shock is a big one, because people, and what's interesting, studies from T. Rowe Price, Vanguard, others have shown that the likelihood of having a very severe, expensive healthcare shock late in life is quite low for the vast majority of Americans. You just don't know if you're going to be in that tiny percent of people who face it, right?
Yeah.
So why not get rid of that risk, right? Get rid of the long tail risk by using what people say, right? When you have a long tail risk, you insure it. You use pooled money to get rid of that risk.
Meaning insurance?
Well, it could be long-term care insurance. It could be a deferred income annuity. It could be a QLAC, right? All these instruments that allow you to diversify the risk because
Right.
you're sharing it with others.
Yep.
Instead of retaining that risk, right?
Well
I mean,
said.
the super wealthy probably can retain the risk of a healthcare shock, right? They have
Right.
enough risk capacity in their portfolios, but the vast majority of Americans need to figure out, how do I get rid of this risk?
Yes. Well, I think you already answered my next question, but the average retiree's biggest fear, and I've heard, it is losing that standard of living. Do you agree with that?
Yeah, and I think what's important about that is, so a lot of times when people go to retire, they don't necessarily know what they're going to do and how they spend their time, right? So, and oftentimes someone might retire and do something for a little bit and then go back to work because they couldn't figure out what to do in retirement. I have one close friend who's probably retired 3 or 4 times, and in large part because he doesn't know what he's going to do in retirement. I think he's figured it out on the 4th try. But I think this notion is important, that before you, instead of retiring from something, that you retired to something.
Yes.
And that you really have a handle on your expenses and your time. I have a dear friend, Farrell Dolan. When he retired, he's from Fidelity many years ago. He said, when I retired, I had 4 buckets in mind: grandkids, gardening, travel, and volunteer work.
Oh, see, that is so valuable. You hear these stories of people who don't know what to do with themselves because they truly are not planning for that.
So he knew exactly what he wanted to do in retirement. And the one problem that he faced along the way was volunteer work started taking over the rest of his other buckets, because he learned that he didn't know how to say no when people asked him to volunteer for this board or this activity or this project.
That's a good problem to have, though, in retirement.
Oh, it was a great problem because most people aren't going to play golf 5 days a week. It would be it would be unfulfilling, certainly for me.
Yeah, no, I can't see ever really completely quit working myself, but who knows? I have so many other interests, but you do hear of people whose, their whole life is tied up with their career, and it's such a jolt, I think, especially if they just retire and don't phase out at all.
Yeah, so I think that would be important for people to really take the time to think about what they plan to do. There's a number of retirement counselors and coaches out there who can help you if you're having trouble. There's a large number of resources. You don't have to think that there's no help out there.
That's such a good point. It's not just the financial aspect at all. And coaches are so valuable for something like that, to help just that objective view to get you thinking about what you really love to do. And so you just answered my next question.
Oh, no.
because what they don't understand until it's too late. Anything else? I mean, pre-retirees, what are they not asking, or what are the tried and true pieces of advice that you find yourself giving to people year after year?
Yeah, so I think for me, one of the most important questions is, not besides understanding what your expenses will be, right? Really getting a handle on it, almost year by year throughout retirement, not using a heuristic like 80%.
Right.
Is to think about what your sources of income will be. And when I think about what your sources of income will be, again, I'll refer back to Farrell Dolan and others, where the notion is what you might want to do is think about your essential expenses, whatever they might be: housing, transportation, etc., and matching guaranteed sources of income against those expenses, so that at a bare minimum, you've got those expenses covered from these sources of money that you'll never outlive. And that could be a pension, could be an income annuity. It's obviously Social Security.
Yeah.
Right.
The biggest annuity there is.
Right. The best annuity there is. It's inflation adjusted, and you'll never run out of your Social Security paycheck. And then if there's a gap between your expenses and your income, you may have to look at your 401k or IRA and say, well, how do I fill the gap with that money? Do I buy another income annuity? Do I use a systematic withdrawal plan? Do I use a bond ladder? Or do I use an income annuity ladder? Do I use bullet shares? Right? How do I make sure that there's money, that there's an asset covering a liability? So, professionals refer to it as asset liability matching. And I think that's really important that you have these assets that you know will cover, for lack of a better term, your floor of expenses, right? And then after that, once your floor is covered, well, the rest of the money could be, we sometimes refer to as upside, right? Money that could be used to cover discretionary expenses.
It's discretionary, yes. And
right.
That's a wonderful bucket.
It's a great, yeah. So Farrell Dolan used to call it the 4-box strategy. Others refer to it as asset liability matching. Sometimes people refer to it as bucketing. Whatever you do, I think you need to have a plan, not just have a really good understanding of what your expenses will be, but how your sources of income match up. Now, and in many cases, it's interesting, earned income does play a role for many retirees, whether it's from part-time work or full-time work or consulting. And oftentimes people will say, well, I need the income because I need it to fund my desired standard of living. Other times people say, I don't need the money, but I need the interaction with people, right? And I just need to stay busy. I don't need the income for living. I just need that. But it can be a very important component, which then you can do a couple things with it, is relieve the burden on your portfolio, right? So one of the things, if you're worried about running out of money, well, anytime you don't have to draw down money from your portfolio is great. So you have that earned income that can fill that gap. The other is, I would say, really important as we think about new products and new research and new laws. Several years ago, back, 2005, no one ever thought about like using a reverse mortgage to fund retirement, right?
And I try to get clients to educate themselves on that, because why not at least know what's available?
Right. And it's true. In 2005, I would talk to financial planners and they would say, oh, reverse mortgages, those are only for people who, are destitute, right? They didn't save enough, blah, blah, blah. Over time, research was done to say, this is an interesting financial instrument that if you were to take out a HECM with a line of credit at age 62, and then you would use it like maybe if the stock market was down, so you didn't have to pull assets from your portfolio, right? Yeah. And that you would preserve that portfolio, and it would you don't want to pull money from a declining asset, but you have this wonderful asset over here that you can take money from that is tax-free, right? Yeah. So, I think people need to be very conscious of the fact that they're on any given day, there's a new product or a new law or new research that says, here's some tools that you could use to make your retirement outcome even better. I just wrote a story, Martha, about something called the contingent deferred annuities, right?
Contingent deferred.
Yep, sometimes referred to as a CDA. So what it is it's insurance for your portfolio. So, one example is, if you were to buy a put on your portfolio, a long-term put, for instance, people sometimes refer to the buying puts as insurance against market declines. So think of it in that regard. You're buying insurance so that if the market declines and you're not able to pull out the money from your portfolio that you thought you were supposed to or could, the insurance would kick in, not immediately, but later in life at the point at which your portfolio was exhausted. So it's a way to protect yourself against both sequence of return risk and longevity risk. Very few people know about it. Very few financial advisors use it, but it's yet one more tool in the toolbox that someone could say, well, let me think about using this. What are the pros and cons of it? What's the cost of it? What's the benefit? And in some cases, it may make sense, right? I'm of the opinion that none of these products are bad, right? They're all like, a hammer isn't bad, a screwdriver isn't bad. It just has to be used in the right way.
If you use it right, exactly.
So, it may be appropriate for some people, and certainly it's appropriate to not dismiss it out of hand because the word annuity is in it, right?
Well,
in the term.
That's exactly what I was just thinking, because annuities are like HELOCs.
It's a trigger word.
It is, and people just automatically say it's bad, and we have to get over that. Educate, just learning about these is all that it takes.
Right.
It's just knowing that you should look into those.
And it's hard work. Years ago, the Roth didn't exist, and the notion of a Roth IRA conversion, is still kind of somewhat new to some people. And when would you do it? And how would you do it, right? And should you do a partial or a full Roth conversion, right? And it is complex, right? There's no doubt about it.
It's very complex, and I'm so grateful for financial advisors that are tackling this complete, whole, nasty financial puzzle for their clients, because And it can't be done without technology to unravel when you should take what out and what you should use first.
Yeah. And lawmakers aren't making it any easier. We now have these new RMD rules and for beneficiaries of inherited IRAs, and it's complex. You couldn't do this on your own, and you really do need to find someone who has the competence and the background and the education and the experience to help you sort through some of this stuff.
With it as you said, as the laws change.
Yeah, and the same is true with Social Security, right? A lot of times there's so much to learn about Social Security.
It's always nice to find an expert on something. And speaking of those Social Security, Bob, you wrote about busting the 5 Social Security myths. Can you give us a breakdown on this and how you suggest they be addressed?
Oh my goodness, you're going to make me test my memory.
Oh, was that a while ago? I'm sorry.
No, that's okay. Remind me about myth 1.
I don't actually have the myths in front of me, but
all right, I will pull it up while we're chatting. But one of the things that I think I will mention is, it's not a myth, but it was on my mind when I thought about us talking, is this notion of how sometimes the first time anyone ever looks at my Social Security statement is like the day before they're going to retire. And right. And I think, people ought to sort of like from early on start getting familiar with that statement and understanding how your benefit is calculated, the importance of having, high earnings over the course of, right, having 35 years of earnings, And
I think that the new, if you don't have a My Social Security account now, the administration is sending out the statements to those folks.
Right.
Which I think is wonderful because it hasn't been on their radar, the younger workers, and that's going to help.
Yeah, and I think the other thing that would be helpful is for folks to start really thinking about when they are claiming, especially for household couples, spouses, is to really think about the surviving spouse. And I once wrote a column that said, if you truly, this was aimed at husbands, if you truly loved your spouse, you would do X, Y, and Z, one of those things being delay Social Security so that your surviving spouse would at least perhaps enjoy a higher benefit, assuming that the male was the higher earner and the woman was the lower earner. And, at the time, what was interesting about that was the comments I got were like, well, why would I want to do that? Right. Like people were like, oh, it's my money. The break even is X, blah, blah, blah. But they weren't really thinking about the downstream effect of a lower Social Security benefit for a surviving spouse, which is important if you're, right, especially if you have no other resources.
Well, and it's important for that spouse who has the higher earnings because they're going to continue to collect that for the rest of their life.
For the rest of their life, right.
So,
and I know sometimes people say, oh, waiting 1 year doesn't really change my benefit all that much. And that may be true, right? That maybe it's a nominal amount that it increases for you, but but it could make a big difference for the surviving spouse. So I think people need to really, just not think about themselves when they're claiming Social Security.
Yes, and I've probably shared this with you before, but those are the hardest client cases. I've had about 3 of them. Well, actually, they didn't hire us because the husband, the higher earner, older, was just bound and determined to start collecting at 62.
Yeah.
And it was the wife who reaches out about information on Social Security. And that's really hard to work with. You can't work with a couple like that.
Yeah. So I was going to tell a couple of myths, I think, right? That it's really important that people understand that if they do claim Social Security before full retirement age, that there will be a benefit reduction. But it's not lost forever, right? There's some myth at times that like you lose it forever, and that's not quite true. And then there's this notion of whether Social Security will be taxed after full retirement age. And, of course, the answer is yes, but it's still from an after-tax perspective, not a pretty good deal, right? Because it's only up to 85% of benefits at the worst case. So you're still getting 15% tax-free. So that's a good thing, right?
Yeah, and you can do things to manage that too. Some people can.
Yeah. That notion of do-overs, right? Where, after FRA, well, for instance, we know that you can only file and then halt it within year 1, right?
Yes.
But after FRA, you can halt it again, right?
Yes, and And people get so confused about that because they say, well, I thought the file and suspend is gone. Well, that is, but this is called voluntary suspension.
Right.
And it's simply stopping the benefit so that it starts to grow again. And so many people and financial professionals may not know about that.
Yeah, and this was a surprise to me, Martha. I just wrote a story about that voluntary suspension and wasn't quite sure if you had to tell Social Security to turn it on at age 70 or not. And I learned that they will automatically turn it back on at age 70.
I would still check though.
I would still check. I wouldn't want to leave it to chance because I thought, that's interesting. But
yeah, that's good to know. That's good to know.
Yeah.
Well, then, so we're talking about financial professionals who are helping their workers plan. Do you think there's specific areas or topics that they routinely fail to educate themselves on? And how can these are the financial professionals, how can they be better prepared to help their clients retire? And I think you've talked about some of these.
Yeah, I'd say, if you think about the things that can cause big problems, a lot have to do with IRA rules. And I think, the degree to which people can avoid mistakes, get better educated around IRA distribution rules, I think would be helpful. I think becoming educated about these products that are out there to be available. And, I one of the things I do is I serve as the editor of the Retirement Management Journal, which is published by the Investments and Wealth Institute. And we just published this study about the use of registered index-linked annuities, RILAs, and how you can improve outcomes. And there are some risks that you can't control, but there's some risks that you can control, and some levers that you can move in order to improve outcomes. And so it's really important that people get a sense of how these tools can help improve their clients' outcomes. One of the things that I think would be important, way back when, I forget what the exact year, but David Blanchett, who was then working with Morningstar, talked about Advisor Gamma, right? What are the things that you can be doing to improve your clients' outcomes? Becoming better equipped to create tax efficient withdrawal systems, really important, right? Because it's not what you earn, it's what you keep, and it's really even more important when your resources are limited in retirement. So learning how to create tax efficient withdrawals, I think, is extremely important. And I think also understanding when to do things. So there's a window of opportunity to do Roth conversions right before, say, age 72. And for that to happen is to understand what someone's tax bracket is and how to maybe manage the conversions so that you're not tripping someone into a higher tax bracket, or if you are tripping them into a higher tax bracket, you understand the consequences, right? Consequences such as triggering Medicare Part B income-related monthly adjustment amounts, right? I mean, I'd say avoid it at all costs, but if you're going to do it, know that that's a downstream effect of a Roth conversion, is maybe pushing someone into a higher bracket, for instance. Or if they're not yet on Medicare, they're on a marketplace healthcare, maybe triggering a loss of their advanced premium tax credit when you do a Roth conversion, right? So there's all these, like, it's the pulling of the yarn off a sweater. It's sort of just being very thoughtful about this, because the mistakes that you make will matter.
Yes. How do our listeners, our pre-retirees, find the financial advisor that can do all this? It's not do you interview? Do you stick with
I think it starts with interviewing. It also starts with you getting some baseline knowledge, right? So I always think that financial planners are so different depending on who you talk to, right? Someone who's regulated by the insurance industry will be different from someone who's regulated by FINRA, who may be regulated differently from someone who's regulated by the SEC.
Yes.
Right. And so what that means to me is what you get is a function of who you talk to. So if you're talking to an insurance agent, maybe it's an insurance-based solution. And if you're talking to someone who's regulated by FINRA, maybe it's a packaged product solution. And maybe if you're talking to an IRA, it might be a little bit more customized. So, and what happens is there are no best practices across the suite here.
Yeah.
It's really, right. It's a function of, who regulates them, what their business model is, what their training and education has been, right? What their biases are.
Yes.
So it really pays, before you even go start to interview someone, I think it would pay for you to learn more about who you're talking to before you even talk to someone.
It gets down to that bit of information, of education you need to have yourself.
Right. And this is important, right? I mean, I'm probably spending more time planning my next vacation, right? Like, I'm joking, right? But more people spend more time spending, figuring out their vacation and what hotels they're going to stay in and what roads they're going to take or what planes they're going to fly than they are about being serious about who they would talk to manage their most important, asset, their money. And I think, for me, it always comes down to who's the advisor who has the most tools available to them to help you accomplish your goals. So the example I always use, Martha, is this. You would never go to a doctor who could only prescribe half the medicines, right, available in the PDR, right, the old physician's desk reference. But that's in essence what happens today. If you talk to an advisor who's not licensed to do X or who's not able to do Y, then you're not talking to someone who has the entire physician's desk reference at their fingertips.
Yes, that's a good analogy.
Yeah.
Really good analogy.
Yeah. So it may mean doing a little bit of legwork and a lot of interviewing, and to understand that, a lot of times what someone will tell you in an interview will certainly sound good, right? I mean, obviously many people have been in business for 10 years, 20 years, decades, right? And they've got it down to a science. They have their practice down to a science.
Yeah.
You just have to make sure that what they're doing is right for you. You don't want to be, what's that old saying about, like, to a hammer, everything's a nail, right? You don't want to be, walking in, and all someone has is a hammer and thinks you're a nail.
Yeah. Oh gosh. Well, I want to cheer up our listeners.
Well, yeah, we can cheer up some of your listeners. Most people are satisfied in retirement. Does that help? Like,
that helps. Thank you. Yes. No,
yeah.
I've read that happiness increases as we age.
Yeah.
So I don't know. Do you have more time?
I do. Yeah, I could talk all day about this,
Oh, okay. Well, I could too. Because if you don't mind, I'll keep asking questions. If someone is planning to retire in 5 years and only remembers one or two things from our talk today, what would you like them to remember?
So 5 years is a good time to sort of narrow in on whether you have the resources to fund what you think your expected retirement lifestyle will be. Because at that point, time is short. So one of the things that's important about that 5 years is you're not going to save or invest your way out of this.
Yeah.
So you're in the home stretch. There are a couple things that you could do that might be make a meaningful impact. One would be to consider working longer if you haven't saved enough. But I would also caution you that while that's a good solution, it only works for maybe half of the people. So the employee benefit, I'm sorry if I'm depressing you again.
No. Nope. This is what we need. We all need to hear this.
Yeah. So the Employee Benefit Research Institute has said, of the folks who want to keep working longer, only half are able to do so.
That's a good point.
Because of a healthcare shock,
Right.
a layoff, the downsizing, who knows, right? There's an unexpected event in your future where you only have a 50% chance of being able to do what you thought you were going to do.
Yeah.
So in that 5-year runway, getting a good handle on what your expenses will be, how your sources of income are lining up. Do you need to save more? Do you need to reduce your expenses? Do you need to work longer?
Downsize.
Do you need to downsize,
Yeah.
right? You need to downsize. And if you're doing this on your own, I mean, again, if all you did was to go see a financial advisor as a sounding board, maybe an hourly planner to say, here's what I'm thinking. Can you look over my shoulder and let me know if I'm directionally right here? That would be helpful. But more importantly is to, actually start crunching the numbers and be serious about things. And I would caution, there's and to become smart about, so there's, we can talk about all day. So one of the things that's really important for people to understand is, like, we talked about the planning horizon being really difficult.
Mm-hmm.
And, oftentimes software will say, oh, we'll give you an age 85 or age 90 planning horizon as you're thinking about this. If you go online to any, online retirement planning software or, a broker-dealer software program, is to understand that the planning horizon isn't a probability. And especially if you're a married couple, the odds of like one person in a couple living to age 90 or the possibility of two people in a couple living to age 85, right, is to start understanding that while it's important to target how many years of retirement you'll have, it's also important to look at the probabilities of someone living longer and what that means. So I'd say for me, the important thing is building not just a plan, but doing scenario planning and what if situations.
For those different life expectancies.
For different life expectancies, for different expense, sort of scenarios, right? I'm going to, spend a lot early in life and save a little bit for later in life. It's not one of the analogies that people make is no pilot ever leaves LaGuardia, right, heading for LAX without a flight plan. But no pilot ever gets to LAX without making adjustments along the way, right? No one just follows that plan exactly according to plan. So I think you have to think like an airline pilot and say, I've got my plan, but I know that I'm going to be making adjustments along the way. And it may mean, again, right, life throws us lots of curveballs. It may mean, your children move back in with you when you didn't expect that to happen, or someone becomes chronically ill, or, you get divorced, right? I mean, it's just
right. That's the flight plan is an excellent analogy. That's
right. I just read, you probably read this, right? There was a passenger on a Cessna airplane.
Yes.
Right.
He
The pilot passes out.
But
Now the passenger has to take over as the pilot.
the traffic controller was a teacher, was a pilot.
Right. And he landed the plane.
He landed it in an excellent way too. That was so fun to read yesterday.
Right. So could you imagine that happening to you? Right. I mean, imagine that's your retirement plan and you have this plan in place and all of a sudden your pilot is gone.
That's, we're getting depressed again.
I don't want you to get depressed. I don't.
Okay, well,
what I would want to do though is inspire people to become, I like to describe it this way, Martha. People ought to become students of the subject. I mean, obviously I am. I eat, breathe, sleep, all things retirement. I wake up reading about it. I go to bed reading about it. I read research reports, and whatnot. Maybe you don't have to go to that degree, but I think you have to become like I watch one of my sons with fantasy football, right? People who do fantasy football, for the most part, are fanatics, right? They know who's injured. They know who's been traded. They know who's been benched. They know who's having, right? I think you have to sort of approach retirement with that same sort of fanatical, enthusiasm that a fantasy football player has, right? Do a deep dive. Become smart about it, right?
Yes, because the rewards of that are literally going to pay off.
Oh, right. And not only that, I always think, there are some mistakes out there that are irrevocable, right?
Yeah.
And you want to avoid those.
Well, like Medicare, the penalties for not signing up for Medicare when you're supposed to are severe,
right?
Lifelong.
Right.
Yeah.
So imagine not signing up for Medicare Part B when you should have.
Yeah.
You mentioned Medicare. A lot of people, right? This is one of the cruelest things that we do to older Americans. We make them, choose a new plan every year. Right. And most people just check the box and say keep the same plan that they had the year before, not knowing that the formularies change and the doctor's network has changed.
But it's good that we can change because our health is going to change.
Yeah, I think it's marvelous that we can change. I think it's also a shame that as our cognitive abilities are declining and our confidence in our decision making rises, that we're asking older Americans to make decisions that may be wrong for them. But the point is, I think there's one of those decisions that could have really costly, right, effects if you choose the wrong plan, right? Or you sign up for a Medigap policy, or you terminate your Medicare Advantage plan and you sign up for a Medigap, but you get to turn down, and now you're like without insurance, right? So there's just lots of potholes waiting for people out there in retirement.
There are.
But imagine if you were knowledgeable about such things, right? You would avoid those potholes.
Or at least know where to go to get that knowledge.
Right.
have a resource for it.
Right. And I think that's where you come in, right? I mean, offering specialized knowledge in Social Security to an advisor, right? I mean, if you ask me where to go, I'd say, if you have questions about Social Security, you should go talk to someone, right, who has an RSSA. Right?
Yeah. Thank you, Bob.
Well, no, you're welcome, but it's true. I mean, you want to talk to an expert. I mean, if you had gastrointestinal problems, you wouldn't go to a cardiologist per se, right? Maybe you would go to a gastroenterologist. And the same is true with Social Security. You should go to a Social Security expert.
Yeah, the trick is to getting that information out there. This next question is a little different. Every once in a while, there's a world event or several events that affect all our lives, regardless of how far away it is. So regarding the war in Ukraine, do you see this having an effect on retirees as far as how much it impacts investing, among other things? Is there a financial impact that is or will continue to affect us from that?
Yeah, I mean, I think we're living in a unique time in some respects, right? We've got a war going on. We've got COVID still present. We've got supply chain issues. We've got a rising inflation that we haven't seen in 40 years. We've got a Federal Reserve that's gone from being dovish to hawkish. And we're now watching a lot of market volatility and stocks and bonds declining in ways that we haven't seen in a very long time. And what I would say is, I actually just wrote a story about this for Market Watch. For folks who, especially for retirees who had a plan in place, they're not actually worried about what's going on in the world right now because their plan accommodated these events. Maybe not these events specifically, but they had a plan in place that accommodated things that would be adverse to their portfolio. They had, I like to describe it as risk capacity. How much money can you afford to lose without it affecting your standard of living? So they had risk capacity built into their portfolio. For folks who didn't have a plan, my goodness, this is the time to get to the starting line.
Yeah, to be aware of that. I mean, this must be hitting people hard.
Especially, the thing is, it reminds me a little bit of the year 2000, when I would talk to people who had, that the run up in the bull market had just sort of ended in like January of 2000 or so. And people were retiring because they were like, oh, I met my accumulation goal, right?
Yeah.
Like, I got enough money now to live the life I thought. And then the market crashed for the next 2 years. And many of them didn't have risk capacity in their portfolio, so they had to go back to work because their portfolio now was down by X percent and it wasn't able to support their standard of living. I think reaching the mountaintop is not necessarily the goal. It's like the mountaintop plus, right?
Yes.
So I think having a plan in place that accommodates worst case scenarios like we're experiencing today is what you need to be thinking about as you build your plan. And I think the good news is for retirees, maybe the impact isn't as great if they built a nice plan. For my children who are in their 20s, well, they've got 40 years of investing in front of them and then some. So, I think this will be hard, but it's not going to affect their quality of life, right? Because they're still in their early years.
Yeah.
It's those people who are sort of on retirement's doorstep, I think, right? They're in that maybe age 50 to 65, 67 range, where this is really, giving them a chance to look at their portfolio, their savings rate. One of the things you asked me about, like, what can people do if they're within 5 years, is to, if they haven't gone through the process of crunching the numbers to see if their portfolio is big enough, is to use some heuristics. Fidelity, T. Rowe Price, others have created these charts that say, oh, by the time you reach 65, you should have 10 times your salary set aside in your 401k or IRA, or 12 times, or whatever the number is. Just do a check-in to see what's the size of my portfolio relative to my salary. And if it's, within a couple points, great. If it's not, man, you've got some things to start. You've got some work to do.
Yeah. How about the philosophical part to retirement? How can people change their mindset or philosophical approach towards retirement to ensure that it's the best time of their life as opposed to a letdown?
Yeah. So I read this study, Martha. It sort of said that we're almost hardwired. I'll say this with a grain of salt. Take it with a grain of salt. that if you're a happy person, you're going to be happy in retirement, right? And if you're kind of an unhappy person, well, that's your fate in retirement, right?
Yes, there's not much, well, but planning, I guess it all just comes back to the plan.
Right. So I would say, like, okay, so you're unhappy. How do you get happy? How do you sort of like maybe move the needle so that your
Let's
retirement
say content
Right.
at least.
Correct. Right. And so I think there's a couple things. There's JP Morgan just published a guide to retirement, and it talks about going into retirement with a purpose. We talked about that already, right? Making sure that you're retiring to something. It talked about having social circles in place.
Yeah.
Right. So if you're like, if you haven't built a network of friends, either through, churches and synagogues and civic organizations or whatnot, you better start doing that now before you retire. Go down to the senior center or join the local, sailing club or whatever it is. Get out of your house. Right. And this is more problematic for men than it is for women, Martha. I'm sure you know this to be true, right? My wife has a million friends, and I sometimes think that I'm a loner, right? Like I'm always introduced as, Amy's husband, not Bob, right? Because I don't know any of her friends. Anyway, she has a huge circle. I don't worry about her in the least, in her retirement, because she'll have this network. Men, on the other hand, they tend to collapse their social networks as they get older. And at great cost, perhaps, right? They need to start expanding it and thinking about, how do I create a community so that I have different things to do with different people? And I think that would be helpful. Those two things would go a long way toward making. I mean, the other thing too, I think, is this. So there was another study done, Boston College Center for Retirement Research, and they talked about what drives satisfaction in retirement. And the three things, I joke, one was retiring on your own terms, right? Not getting laid off. One was being in good health. And I think there's something that, people really need to think about as they age, is how do I stay healthy? Do I, should I start riding a bike or playing pickleball or, lifting weights or paddleboarding or whatever it is, right? You can't disregard your health as you get older.
No, and finding that that exercise that you enjoy, so you keep doing it.
Right. And then the third thing that drove satisfaction, though I joke sometimes that I don't believe it, was being married. And
that depends.
I think it depends. But those are the three factors, right? Retiring on your terms, being good health, and being married. And I think there's a lot of truth to that. Is, those three factors, are important. And then having a purpose, and then civic engagement or social outlets will be really important to folks. Yeah. So you can go from being unhappy to happy.
Yes, I believe so too. Well, it's so fun to talk to you, Bob, but wow, we're really coming up on an hour here. So lastly, where can people go to learn more about you and gain access to your extensive collection of writings? You have so many things going on. What's the best place to?
I'd say start with retirementdaily.net. That's the site I run for TheStreet. That's a place where they'll find the videos that you and I have done that are in our Retirement Daily Learning Center. That website features my work as well as articles written by other financial advisors, writing about a vast array of topics from Social Security to Medicare to IRAs to estate planning to income taxes to insurance, et cetera. We also have a section where we call it Next Gen Money, where we're trying to write articles that would be of interest to young adults who are trying to get their start in their careers and learning about saving for retirement or saving for a house or buying a house or whatever. And so
I'm going to send my son there.
Yeah, I think it's great because we're working with young financial planners who are part of the Financial Planning Association's Next Gen community. And these are all advisors who are in their 30s and 40s and writing. Yeah, it's been great. And that's a good place to start your search for things that I'm writing. And then if you want, you can search me at MarketWatch or USA Today. So.
Okay. Well, that's it for today. Thank you, everyone, for listening to our podcast. Please tune in every Wednesday for new episodes. Our expert guests share a wide variety of knowledge on retirement-related topics. See you next week.